Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically we are now started the topic of the banking reforms and the mergers. Okay, so far we had completed the topic as first topic which we had completed is the introduction to the banking awareness, right? Second topic which we had completed was the banking history. Okay, third topic which we had completed was the banking evolution, right? Fourth topic which we had completed was the types of banks, right? And right now we had started the discussion over the banking reforms and mergers. Okay, so I hope that you have revised the previous lecture well enough, because there were so many things which we had discussed in detail. All right, so that now we could proceed with the another details. Okay, so let's begin. This is the topic which we had started so far, and basically we had completed the banking reforms part. We had completed banking reforms part. Okay, so now we are going to start with the banking mergers. Okay, but now before starting with the banking mergers, let me tell you some kind of things. The first is, what do you mean by the merger? Second is, what do you mean by the acquisition? Third is, what do you mean by the subsidiaries? Okay, these are the 3 points which we need to discuss in detail. Then only we will be able to grasp the upcoming facts in a proper way. Alright, so let's first start with the point merger. Like, what do you mean by the point merger? It is a combination of two or more separate entities which come together to form one new single entity. That's we call the merger. Okay, let's take example. Suppose we have company A, we have company B. These are the two companies we have right now. All right, thereafter there is a condition that after some time or after some period of time, basically A and B decided to merge together. Okay, they had you can say push their resources and their liabilities together, and then they formed a new entity called company C. This is an example of merger. All right, second is the term we call the acquisition. Term we call the acquisition. So what do you mean by the acquisition? A practice of acquiring more stakes or shares in another company to get control over management rights. Okay, this is called the acquisition. All right, so suppose we had the company XYZ and we have the person Mr. A. Okay, as I had told you, every organization has its 100% stakes or shares. All right. And basically, who will be the owner of that particular organization is decided by who is holding the maximum shares or stakes. Maximum shares or the stake. If someone is holding more than 50% of the stake in any organization, then that person will be the owner. All right. So in that case, Mr. A owns nearly about 20 or sorry, for nearly about 52% of stakes or shares. Okay. So Mr. A will be the owner. Technically, why? Because he is holding 52% stakes. All right. But here comes the second company called BCD. Okay. And we have owner Mr. E. After some time, Mr. E made the investment in XYZ and now he is holding 53% stakes or shares. Got it? 53% stakes or shares. So now if we go by the technical definition which we had just recited few minutes ago, then who should be the owner in that case? Now the owner should be the E, because now E is the one who is having more than 50% stakes in the XYZ. This is called the acquisition, in which a company acquired the another company by purchasing the maximum stakes and holding the management rights. All right. Thereafter, second one is called the subsidiary company. Third one, sorry. What do you mean by the subsidiaries? So, organization or company working under or controlled by a parent or holding company is called the subsidiary company. It means this is the company which is working in a particular domain, but it is being controlled by the parent company. Okay. For example, suppose we take the example of Tata Group. It's just an example. Okay. So Tata Group having various companies and various work profiles. Like we have the Tata Consultancy Services, TCS. We have the Tata Steel, Tata Iron and Steel Corporation, TISCO. We have Tata Finance. Okay. And now we have Tata Technologies. So these all are the company within themselves. Okay. And these are working in a particular domain. Like it is an IT domain, it is a heavy industry domain, it is in a financial domain, it is in a technological domain. But all of these companies are managed by the one group or are working under the one management called the Tata Group. So this is the example of subsidiary company. All right. So now I hope that you have got the clear understanding under the terms merger, acquisition, and the subsidiaries. Merger is a combination of two or more separate entities come together to form a new single entity. All right. Thereafter, acquisition, a practice of acquiring more stakes or shares in another company to get control over the management rights. All right. Subsidiary is basically the organization or company working under or controlled by a parent or holding company. Okay. Third is the question which we have is merger and consolidation is same or not? This is another question which we should clarify. All right. Is the merger and the consolidation is same or not? So if we first talk about the similarity between the both. So the one thing is similar is that combination of resources. This is the similarity between the both. Whereas if we talk about the difference, like what is the difference between the two, then the difference is formation of new entity. Okay, now let's discuss it. Okay, so in both merger and consolidation, the one thing is same. Two or more entities come together and combine their resources. All right, like in merger, we had a companies A plus B. Okay, same thing will happen with the consolidation A plus B. Okay, but if we talk about the difference between them, then the difference is formation of a new entity. Okay, in merger there is a formation of a new entity. All right, like A and B combined together and the new entity C was formed. Whereas in consolidation, no new entity is formed. It means A and B will be the AP. Okay, here a total new company was formed. Here the existed companies just combined together. Okay, so remember this difference. Okay, so now I hope that we had make a starting point clear. Now let's begin. So if we talk about the banking mergers, so they involve the consolidation of two or more banks to form a single entity, as we had discussed. Okay, mergers are undertaken to enhance operational efficiency, improve financial strength, address challenges faced by the banks. Okay, so these are the main you can say reasons why the mergers have taken places. First is enhance the operational efficiency, how we will discuss. Second is improve the financial strength, how we will discuss. Third is address challenges faced by the banks, how we will discuss. Okay, so now let's begin. So the first is the term we call the scale and efficiency. Okay, let's start. Mergers lead to the creation of larger banks with broader geographical network. These scales can result in significant economies of scale and operational efficiency. Larger banks have the capacity to invest in modern technology, streamline processes, and optimize resources utilization, ultimately reducing cost. So first, if we talk about the scale, then the scale means with the you can say growth of business, or you can say presence of business. We have these two terms. Okay, so basically if we start talking about them, so suppose we have the bank A, we have the bank B. Okay, so bank A having the 10 branches, bank B also having the 10 branches. Okay, these both having the 10 branches. Bank A had decided to reach or to establish new 10 branches. Similar thing has been decided by the bank B. 10 branches, 10 branches. Now the question is, if they will go to establish the new branches, what will be the hurdle they will face? Capital adequacy, rules and regulations, and other things also they might have to face. All right. So they decided that they should merge together and formed a new bank called the Bank C. Okay. So when they will merge, their branches will also get merged. All right. So it means the new bank which will be formed after the merger will having 20 branches. Okay, that was the motive behind their merger, because they wanted to establish the 10 branches to reach the level of 20, and now they have the level of 20. Okay, so the first thing we had cleared is the scale, like how the scale of the banking business will be you can say enhanced. Second is the capacity. All right, so suppose you can say Bank A having the balance of 20 CR. So does Bank B having the balance of 10 CR. Alright. Bank A wants to acquire Bank A wants to acquire a new technology which is worth rupees 30 crores. Okay. Similar thing has been aspiring by the Bank B. So Bank A required 10 crores extra. Bank B requires 20 crores extra. Alright. So they both decided that they should merge together and form a new bank which is called the Bank C. So when they get merged, their capital will also get merged. So does we can say the Bank C will have the balance of 30 crores. The same amount which was required to acquire the new technology. Okay. So that's how they could improve their efficiency. Second one is the NPA resolution. Okay. Weaker banks with a high level of non-performing assets can benefit from mergers. Stronger banks can help in the resolution of NPAs by leveraging their expertise and resources. The consolidation of NPA-ridden assets can improve the financial health of the merged entity, making it more resilient to the economic shocks. Alright, so suppose we can say we having two types of banks here. The first is the Bank A, which is the larger bank. Second one, we have the Bank B, which is the smaller bank. These two banks we have. All right. Now, here comes the condition. And what is the condition? Let's discuss. Basically, Bank A wants to reach the 20 branches. Okay. Whereas Bank B is facing the NPA loss worth rupees 40 lakhs. Okay. So here comes the mutual needs. Alright. Bank B having 20 branches. Alright. Whereas Bank A having the reserve for rupees 40 lakhs in an additional way. Alright. So by the mutual understanding or the need, both the Bank A and the Bank B decided to get merged. Bank A plus Bank B. They both decided to get merged and they had formed Bank C. Okay. So in such a scenario, the Bank B, which is having the NPA loss rupees 40 lakh, will be settled off because the Bank A having the additional reserve for 40 lakhs. Alright. Whereas on the second hand, you can say Bank A, which is required the 20 new branches, will get the settlement from the Bank B, which is having the 20 branches. It means they could justify their needs by the merger. Okay. And could also give the resolution to the NPA challenges. Alright. Because now the Bank A gets the 20 branches for which they were searching and Bank B got the total amount to recover their NPA losses and fulfill their obligations. Alright. And this could prevent the banking sector from the economic shocks. How? Let's discuss. If suppose the Bank A and the Bank B will not get merged, then what will happen? The Bank B, which is suffering the losses of 40 lakhs, if the Bank B fails to meet this obligation, then the bank will be declared as bankrupt. Alright. And this will lead to the loss of whom? Loss of depositors. And because the depositors are also the part of the economic activities, so loss to the economy as well. Okay. So there might be this kind of shocks. But as we know that the Bank A and the Bank B get merged over time, it means that their problem for having the NPA resolution would be resolved. Got it? Thereafter, we have the capital infusion. Mergers can facilitate the infusion of capital into the weaker banks by the stronger banks. This capital injection strengthens the capital base of the merged entity, making it more capable of absorbing losses and maintaining financial stability. Alright, capital infusion can also enhance the lending capacity of the merged entity, supporting economic growth. So we can say if we have the two banks, first is the bank A, second is the bank B. Alright, bank A requires rupees 40 lakhs to stay in the market. Bank B also required rupees 30 lakhs to stay in the market. Alright, so if they get merged and they formed a new bank which we call the bank C. So the bank C will having rupees 70 lakhs as a total capital. Why? Because the capital of both the bank A and the bank B get merged and now they having the new capital, which we call a term known as capital infusion. It means that their capital was get merged over time. Alright, this will enhance their capability to stay in the market and enhance their capability in the competition and ultimately leads to the capacity enhancement in the lending terms. Alright, thereafter, rationalization of the branches. Alright, mergers often lead to the rationalization of branches, eliminating duplication and reducing operating cost. Overlapping branches may be merged or closed and resources can be redeployed to areas with greater growth potential. This optimization can enhance the overall efficiency of the banking network. Okay, suppose we having bank A, we having bank B. Okay, bank A total having 20 branches, bank B also having 20 branches. Alright, there is a consumer base for 100 customers in the city. Alright, these 100 customers are getting divided by 50 customers each. Okay, due to the presence of the branches. Now, both the bank A and the bank B are suffering the losses by you can say accelerated operational cost. It means that they are bearing the cost of 20 branches, but their customer base is getting segregated and now they are not receiving back what they had invested. It means they are suffering the loss. So after some time, by consultation, by understanding the need, they had decided that we should get merged together. Okay, and they had formed a new bank called the bank C. Okay, so the bank C will having the 40 branches. All right, because when the two banks will get merged, it means that their branches will also get merged. All right, but there are only the 100 customers. Okay, and if we look at the previous case, when we have 20 branches, the customers were divided in the 50-50 customer base. So when we have the 40 branches, so the customer will be divided into 25 customers at each branch, right? This will be the outcome we have. But if we look the previous case, even in the 50 customers, we were suffering the losses, or you can say bank A and the bank B will suffering the losses. So when they get only 25 customer at one branch, so okay, let me correct it. 25 customer at every 10 branch. All right. So their losses will be higher than the previous one. So you can now ask me, sir, what was the motive then? Like they had got merged so that they could reduce the operational cost. Okay, but as we can see, when they get merged, they have increased their branches, and now they have reduced the customer base even from the previous one. So it means that they will face a huge losses than the previous one. All right. So what is the rationality? The question is in that form. Why? Eliminating duplication and reducing operation cost. It means that if they had a need of 20 branches and now they get the 40 branches, total need was only for the 20 branches, so that they could concentrate the 100 customers at one point only. All right. So they will close down the duplicate branches. All right. So it means eventually they will get only how many branches? Only 20 branches. Okay. And now the 100 customers will be get merged on 20 branches. All right. But their expenses and all the things will go only to the one bank, branch C, instead of two banks like the bank A and the bank B. All right. So this is the scenario. Let summarize it in a simpler form so that we could conclude it. We have the two banks, bank A and the bank B. Bank A having the 20 branches, bank B having the 20 branches. Their customer base was 100 customers. But due to the options, the customers got segregated as the 50-50 base. Because of this, both the branch A and the bank B facing the problems or the financial losses or the operational cost losses. So they decided that they should merge and form the new bank, bank C. When they get merged, their branches will also get merged, and now they have the 40 branch, which leads to the 25 customers at every 10 branch. So we can say their loss would increase instead of decrease. Okay, that's why they eliminated the duplicate branches, and now they had reached the level of 20 branches. It means now the customer base of 100 customers is getting on the 20 branches. Even in the case of 50-50 customers, now the money is only going to the one bank instead of going to the two banks. Okay. All right. It means now their efficiency and their optimization of the overall efficiency is going increasing. Got it? So this is the rationalization of branches. Second one is the enhanced governance. All right. Merged entities can benefit from improved corporate governance and risk management practices. The stronger governance structures are often implemented to ensure that the bank's operations are conducted transparently and in compliance with regulations. A stronger governance framework can enhance trust among stakeholders and boost the bank's reputation. All right. So basically, we can say when the bank A and the bank B get merged, so not only their financial resources, fiscal resources get merged, but also their human resources also we call them human capital get merged. All right. So suppose we can say if the bank A having a good marketing team, okay, good technical team, all right, whereas bank B having a good financial team, all right, good legal team, all right, and when they had formed a new bank called the bank C, it means that the new bank will have good marketing team, good tech team, good finance team, good legal team. Okay, all in one scenario. All right. So the stakeholders and the shareholders who were a part of bank A and bank B previously, now when they got a combination of all the things in a one place, so it means that their confidence in the bank, like bank A and bank B, will get increased, because now all the things get combined together and the bank C will become a robust entity. All right, this is the enhanced governance scenario. All right, thereafter, the market presence. Mergers can help banks gain a stronger presence in the specific regions or sectors. This expanded market presence can lead to the increased market shares and a broader customer base. Bankers can leverage their combined expertise to better serve the needs of customers in those regions or sectors, potentially leading to increased business opportunities and profitability. Okay? So we can say when the financial resources, okay, when the human resources, okay, when the physical resources, okay, and when the confidence of stakeholders, when all of these things combine together, this will automatically provide a competitive edge over other competitors. All right, and thus it means that the bank's market presence will also get enhanced. All right, so that's why the mergers are also helpful. Okay, so these advantages highlight how bank mergers can lead to more efficient and resilient financial institutions that are better equipped to serve their customers, support economic growth, and adapt to the evolving marketing conditions. All right. However, it's essential to note that the successful mergers also require careful planning, integration, and effective management to realize these benefits fully. All right. It means that if the bank A plus bank B getting merged to form the new bank called bank C, it means that their rationality and their successful planning should be required at a point. It means if the bank and bank B planning to get merged, then they must know everything about each other, and they must be aware that what will be the consequences when they will get merged and form the bank C. All right. For competitive exam, it is essential to have a comprehensive understanding of the banking reforms and mergers, as questions related to these topics are frequently asked to assess candidates' knowledge of the banking sector and its regulatory environment. Okay, so when you are going to the part of banking industry, okay, and if you are targeting the banking exam, so suppose you are getting the job in bank A, okay, and suddenly you received a news that the bank A is getting to get merged with bank B, and then there will be a bank C. All right. So now imagine yourself, if you are a part of that industry and suddenly, or not suddenly, but after a successful planning, both the bank A in which you are working and the bank B get merged and the new bank, bank C, was formed. Okay. So you must be aware about the things, right? If you're not aware about the other things, then how will you expect yourself to work effectively and efficiently during this time? Right? That's why it is very, very important that you must have a complete knowledge. Okay? It is not only necessary. I have told you so many times. It is not only necessary that you should clear the exam. Because even after clear the exam, there are so many things you need to do. Okay? Your promotions, your reputation at your workplace, all right, your self job satisfaction, all the things are dependent upon your knowledge, your presence, and your aura which you have made at your workplace. Got it? So this is the scenario. You may clear the exam, but you are not having a clear cut knowledge about the things, you won't be able to survive along in the industry, This is a cruel thing I am telling you right away. All right. So I hope that you have followed these things properly. Okay. So I wish you all the very best. But we will continue this lecture series. Okay. We are not ending it here. Do not worry. It's just a friendly gesture and the well-wisher gestures I have showed you. Okay. So please revise the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and thank you.